Are we in a stock market bubble? When people are searching about a stock market bubble more than they did after the pandemic crash, it's worthwhile to understand whether we actually do have one on our hands. So in this video, I want to share with you a few indicators I've been looking at to see whether we do have a market bubble. And towards the end of this video, I'll share with you where I think there are currently opportunities. As usual, I happen to be a random Asian guy that have popped up on your YouTube feed, so this is definitely not financial advice. Okay, let's start off with a quick recap of my portfolio. And I use ShareSite to track my portfolio. I'm not sponsored, but if you do want to try it for yourself, I'll leave a link in the description box below. Now, currently for this CMC market portfolio, it's worth about 95,000 Australian dollars. I've made no changes on this side. And the one thing I do need to work on is that I still have about 9,000 in cash I need to deploy. I'm slowly working through things to figure out where to allocate capital next. But honestly, the situation doesn't get that much better for my US portfolio. So this is Stake. I use Stake to do most of my investing outside of Australia. It's currently worth about 31,000 US dollars, which is give or take approximately 40,000. Even though I am not comfortable with the amount of cash I am holding, I am taking my time to think a little bit more in terms of where to allocate capital next. Now, the one thing I did change about this portfolio is that I added a 1% position in lit. The main reason for this is that I wanted exposure in the battery supply chain, especially in the Chinese, Japanese, and Korean industrial companies. It was just really hard for me to get access to those using Australian ETFs. So this was my preference of getting exposure into those companies. Other than that, everything is still mostly the same. Now, before I get into the indicators, you need to know that I am not trying to time the market, as in sell my portfolio and then try and buy at the bottom. That to me never really ends well. And missing 10 of its best days in the market, 50% of my future gains are going to be wiped out. So that is not my goal of looking at indicators. My goal is just to understand where to put my money next. Now, one of the first indicators that I like to look at is called the Dumb Money Confidence by Sentiment Trader. And this is a free indicator. So if you want to check this out yourself, just Google Sentiment Trader with dumb money. It should be the first organic result. Now, I like to come here to get a gauge on how investors are currently feeling. This is a sentiment indicator, not a valuation indicator. It doesn't tell you whether the market is too expensive or cheap. The black line you see is the S&P 500, and then the maroon line is the dumb money confidence. It's only when it crosses above the black dot line is basically telling you that investors in the market are generally feeling really confident, really optimistic, and not really expecting anything to go wrong in the near term. On the other hand, when the maroon line crosses the bottom black dotted line, people are really pessimistic. So for me personally, I've tried to train myself to think more positively when the market is overly pessimistic and think more cautiously when the market is really confident and really optimistic. That's because they're expecting everything to go right, and we all know that life just don't pan out the way we expect it to. As it stands, the dumb money confidence is currently at 0.73, with S&P 500 being an all-time high. If we look at another index, CNN Business, the Fear and Greed Index is at 56, and people are still relatively greedy, even though it has been somewhat correcting back into this territory right here. Now, if I just show you one more chart, this is the equity put call ratio and the 50-day moving average. Now, the way to understand this is that when you buy a put option, you are expecting that the market is going to go down. So you basically want to buy some protective instruments to protect your portfolio. So when this ratio is really high, people are generally, or investors are expecting the market to go down. So that's why they buy put options. On the other hand, when people buy call options, they're expecting the market to go higher up, and that's why they want to buy call options, right? So this is only January 2021, so this number might have changed, but the last time we were getting so close to 0.4 is kind of during the dot-com era. So investors are really positive at the moment, and that concerns me. Now, even though the relationship between dumb money confidence and S&P 500 isn't exactly perfect, because people are so optimistic, it's telling me that their expectation is that everyone will get vaccinated. When the economy reopens, they're going to consume like no tomorrow, and we're going to go back to normal. But we all know that that's not how things pan out to be. Life just don't pan out the way we expect them to. And I know I keep coming back to this point. It's just that when their expectations get crushed, these are the people that panic, and then there's knee-jerk reaction everywhere. And what does Warren Buffett always say? be greedy when others are fearful. Okay, let's look at some valuation metric to see whether the market is expensive or cheap. Everyone knows of the CAPE ratio, and Star Capital have produced a set of research papers that explore the relationship between S&P 500's total returns and CAPE ratio. What they found is really interesting. What they found is that for periods where CAPE ratio went really high, above 22, which is the light gray area that you see on the screen, the next decade of total returns in the S&P 500 is going to go sideways. And total returns tend to go back to normal when CAPE ratio kind of returns sustainable level. The problem is that graph only goes back to 2016. So let's look at today's CAPE ratio. Well, currently the S&P 500's CAPE ratio is 37.56. If this is a race to match our CAPE ratio back in the 2000s, we are doing a freaking great job. Yes, money printing and interest rates would have played a major role in propping up the asset prices. But before you go, oh crap, the market is super overvalued, consider these two things. If investors have government bonds, which is basically you lending money to the government, that capital is literally burning away by the minute. So that forced investors to take more risk, either in the equity market or look at crappier bonds to get the same return. Also, the top 20% of the S&P 500 are tech monopolies. Apple, Facebook, Amazon, Google, Microsoft. They have pricing power, they have growth rates. Investors are just willing to pay more for them compared to a tobacco company. In saying that, if people are willing to pay more for tech in S&P 500, so does that mean that tech sector is incredibly overvalued? Because maybe, just maybe, it's not the entire S&P 500 that's frothy. It's just a few sectors that's incredibly frothy.
Now I dug deeper and I used about 10 to 11 years of Shiller PE data to see if there was any sectors that was more expensive compared to others. Now there's no reason for the date range, it's just mainly whatever I had access to me. And I've condition format this so that the higher their current PE ratio is above the historical average, the more red it is. So I was genuinely surprised that consumer cyclicals and also communication services was almost doubling their historical average Shiller PE. And I wonder if the institutional investors have over-rotated into these sectors because they are anticipating that the economy reopens, the whole reopening trade. So that's something to be aware of. But again, we have to ask the question, what exactly is inside consumer cyclicals? I haven't dug into that. That's a bit of homework for you to look into. Now, the next category that was quite expensive is the industrials, technologies, and also the basic materials. Now, basic materials, we have already seen commodity prices gone up. I'm not very shocked at this sector. To be honest, I'm not shocked about both of these sectors either because technology tends to come with a higher valuation. People are willing to pay more for it. And for anyone who's not considering cybersecurity, digital transformation, after the pandemic, they will all have to seriously think about that. So yeah, I'm not really surprised. At the same time, I also wasn't really expecting financial services to be just the cheapest one out of these. I don't really understand the reason why. Maybe it's because the whole idea of decentralized finance is completely disrupting the financial services sector so that the market is just not really giving them benefit of the doubt. Maybe there's a bit of reopening trade of people rotating money inside. Or maybe I'm the idiot and this is an incredible opportunity. It just turns out to me that there are a few sectors that's incredibly expensive, but it doesn't mean that all sectors are expensive. So sometimes it's easy to say that the market is overvalued, but at the same time, there are obviously a few sectors that's really pulling the overvaluation numbers up. Now let's look at another valuation metric, and that's total market cap to US GDP. Blue line is the total market cap. Green line is the GDP for US. Red line is the total assets of the Fed. Now, as you can see, during the pandemic, there was a lot of money printing and a lot of increase in assets. It's not even comparable to what happened in 08-09. And the observation I'm making when I'm looking at this chart is that the market cap for all of the companies in the US have shot up, but the output is not quite there. So, I mean, this is even after the pandemic, right? The narrative that's being told right now is that people will get vaccinated, we'll all go back to normal and consumption will shoot through the roof. GDP should kind of bounce like a freaking pogo stick. Now, whether that happens or not, I don't know. I don't think anyone really knows, to be honest. But this steep increase in asset prices is what scares me. So let's look at the same valuation metric in ratio, just to give you some perspective. Now, without including the Fed's assets, the total market cap divided by GDP is more than 200%. And including the Fed's assets, which is money printing, the ratio is about 150%.
I'll be lying to you if I say that I don't believe the market is bubblish. But I think more specifically, there are some sectors that are incredibly expensive. So the question now is, where am I looking for opportunities? I think there are opportunities in two places without taking into account crypto, because that should really be a separate video. In my inflation video, I documented different types of inflation and why I think this time inflation will show itself, especially in the CPI. And one of the ways to prepare for inflation is a truly scarce asset like commodities. You can't really print more commodities. And it's even better if that commodity has a very strong structural tailwind pushing that forward. Over the last few months, input costs like corn, aluminium, copper, and even lumber have skyrocketed in prices. But copper is by far the most interesting to me. Why? Because if the world truly wants to go green, copper is a key ingredient for solar panels, wind farms, and your electric vehicles. With CRU Group expecting the copper market to go into a deficit in 2021, it creates this huge tailwind and opportunity in copper mines in the near future. I am in the process of making a video on how to invest in commodities and also copper, so make sure you subscribe to my channel and click onto the bell just so that when that video is live, I can let you know. Another opportunity I've been looking at is different countries. Just because US is reaching a crazy PE ratio doesn't really mean that every other country is doing the same thing. The incredible advantage being a retail investor that not a lot of people talk about is that we're not bound by geographies and we're not bound by asset classes. We get to do what we want across the world. What you see on the screen right now is the global CAPE ratio by country. UK and Canada seems pretty reasonable, and yes, I know that there is a lot going on in UK at the moment. But where I spent more of my time recently is understanding the markets in both China and Hong Kong. Now, one of the reasons why I've been spending more time looking at the East, especially China and Hong Kong, is because they really haven't borrowed against their future like the US. GDP growth looks really strong, some great internet companies, and yes, I acknowledge that it is quite turbulent over there at the moment. But this is one of the reasons why I don't feel comfortable enough to pick individual companies inside those countries. So I have an ETF that gives me broad exposure to that. Now, overall, I think that investors are a little bit too optimistic, especially during markets when it's quite expensive. They're not expecting anything to go wrong. They're expecting everything to just go back to normal. And we all know that life doesn't pan out the way we expect it to. So for me, I'm going to be extra cautious during this period, and it doesn't mean that there isn't opportunities. There are. It just means that we have to work a little bit harder for them. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.